Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back. We're going to review all of the trades that we made here on Friday to close out the expiration month for August. Now, I'm actually recording this video on Monday morning, and I apologize that it wasn't sent out earlier, but as a lot of you know, my wife and I have just moved from our home in Virginia up to Pennsylvania. We're currently living with family, and then I have a storage unit for a little bit, so kind of a little bit of an in transition period, and I just haven't quite gotten the internet speed hooked up and upgraded at the new place that we're living with family. So apologize for a little bit of a delay, but hopefully we should get right back on track. And wanted to get this video out to you guys Monday morning, just so you guys can again see what we did on Friday as far as all of the closing trades that we made. So we'll go over these in detail for sure. And then as always, if you guys have any questions or comments, please let me know. Add them right below this video, and obviously share this video online to help us spread the word. Now, on Friday, we had a lot of closing trades because it was the end of the month, so a lot of different things that we'll go over. So let's start off with SPY. So SPY was a closing trade that was actually a September trade, but we had traded SPY as it was heading lower. We actually went ahead and sold a put spread on the SPYs, the 180, 179 credit put spread, then went back in and bought it at a 17-cent debit. And really, the reason that we went in and bought it back in is because the market has rallied off of the lows from where we sold it. Implied volatility has come down. And so everything that we wanted to happen for SPY and our credit spread happened. So at this point, it's not worth holding another 30 days for just a 17-cent credit. We made over 50% of our potential gain. So we made $23 on each of these spreads that we bought back. So really nice trade in SPY. Again, when we go to the chart and just kind of visually take a look at SPY, you can see that the market has rallied strong off of the bottoms, right? And we sold this spread down here when the market was low, right? And knew that we were taking a chance, but our strikes were so far out of the money because implied volatility was so high. That was a very, very low risk trade. And now that implied volatility is back down around the 20th percentile, that's obviously much lower than above 50 where it was before. And so now you guys can see, I guess, how powerful it is to trade these things at the right time because they give you a lot better trading opportunities and a lot quicker profits than if you were to trade it in low volatility or in the wrong direction or whatever the case is. Our next trade that we let expire, completely worthless, was FCX. So FCX was a trade that we had a call broken wing butterfly on, and we originally entered the 38, 39, and then skipped over the 40 strike and bought the 41 strike. Now this broken wing side over here gave us virtually no risk to the downside. So we took in a credit by entering this trade, and that's basically all that we got out of the trade was our credit, or our $9 credit on each of these broken wing butterflies. Now ideally what we wanted to see happen was FCX rally and close at 39, right? That would have given us the biggest profit potential. But by doing this broken wing butterfly and going out to the 41 strike and skipping over the 40 strike, taking in that credit gave us absolutely no risk to the downside. And that's how we set up a lot of our broken wing butterflies. So when we actually go to the chart here of FCX, you can see that the stock just really kind of tanked, right? And we had traded this, I think, all the way back up here when it was around 39 or so, or just kind of over 39. And the stock just really tanked. And had we traded a regular butterfly, we would have absolutely lost money on this. It would have been great to see the stock kind of finish right at 39, but we made a directional play and took in a credit, and so it was a small little win and profit. Basically a scratch trade after commissions. Okay, the other trade that we closed out today is September MCD, which is McDonald's. Again, very similar concept to what we did with SPY. We originally were short the credit put spread, the 90, 87.5 puts. We bought those back for 25-cent debit. Bought them back a little bit early in McDonald's, but again, nice little rally off the bottom. Made 20 bucks on each of those that we bought back. Nice trade at McDonald's. The other two trades that we closed out of were both of our VXX trades. And I wish I had waited just a little bit longer to close out of the August trade because we actually took a small loss on that one. But I didn't know if at the end of the day on Friday, the VIX and the market was going to head down, and so the VIX was going to go up. VXX is an ETF that's derived off of the VIX, so it's going to move in relation to where the VIX goes. And at the end of the day, it actually ended out of the money. This would have been total winner. But again, you just don't know at the end. I know some people got out of it at the end of the day and made a profit. Other people got out with us and made a small loss on this trade. But at the end of the day, I guess the whole idea with both of these trades is just the mentality and the concept that you have to understand around duration and waiting for these trades to turn around, right? VXX basically went against us the entire month of August, except for about the last 3 or 4 days. And I had a ton of comments, probably over 30 comments in the membership area from members who were asking what adjustments we would make to VXX because it was going against us pretty much the entire month, right? So our first strike was at 29 and then 30 originally. So really the entire month of August, VXX was going against us. This is kind of our first strike here, this line in the sand around 29. And the entire month it was moving against us. But again, if you keep your position size small and you can weather this type of a move, then eventually you're going to get some sort of market cyclicality. And that's what we knew was going to happen. That's why we kind of doubled up on the position by adding to the position for September, even though we already closed out of it because it was profitable. But we doubled up on the position because at least with the VXX, we know that the VIX is going to be pulled downward, constantly. It's going to be pulled downward as the market moves higher, and that's really going to create a strong bearish move in VXX. But again, if you can weather the storm by trading small account positions, then you have the ability to wait for the last 3 or 4 days for this thing to turn into a profitable trade. And again, this gives you a really clear concept on the idea of extending the timeline of your trade. Some people call it the duration of your trade, but trading small positions so that you can weather storms like this and then eventually wait for a potential profit. Now again, in our case, we got out of it a little bit early. You see that on Friday it was rallying really hard and it was going back above 30. So we want to kind of save a full loss potential because we were right there at the end of the day. And again, it closed well below 29. So we would have been very safe, but we didn't want to risk it, didn't want to run into a big issue. Now we did close out of our September VXX position as well. And that was a little bit bigger position. We took a $15 profit. So overall, a small profit on these trades, but again, just a really good concept to understand with this extending the trade. The other trade that we closed out of was GS. GS was our Goldman Sachs calendar spread that we had then turned into a diagonal spread. So we had our Goldman Sachs calendar. We originally had the August-September 180 call calendar. As Goldman Sachs went lower, and you guys can go back in some of the video tutorials about that, as Goldman Sachs went lower, we rolled down our August 180 call to the 175 call. So we took in a credit to roll down that call and basically saved a pretty good loss on this trade. So even though it was 2 lots, we only took in a $27 loss on each of these because we had made that adjustment to roll down the call side for August and basically take in more credit. Now, what we did is let that August contract expire worthless since it was out of the money on Friday, and we closed out of our September 180 calls that were trading for about 70 cents. Now, some people wanted to actually leave this trade on and said, Kirk, well, I want to leave this trade on as kind of a lottery ticket for September. And that's okay, but you just have to understand that since it does still have a 70-cent value, by leaving this trade on and keeping a long option for September, you're still at risk of losing that extra 70 cents. So in my opinion, it was better for us to lose about $25 or $27 on each of these, close this thing out, take in the credit now, than to potentially play this lottery ticket in Goldman Sachs at the 180 strike and hopefully have the stock move well above 181 after your break-even point. So again, it's definitely something you could do, but you just have to understand what you're going to be doing with that money as far as losing that premium. So you can see here, Goldman Sachs, this is where we were looking at. The stock did rally towards our strikes. That's what we wanted to do. But then at the end of August expiration, the stock kind of fell. As the stock was falling, again, then we rolled down our 180 strike, which was up here, to 175, which is right about here. So we rolled that strike down, and that gave us some extra credit. We got a little bit closer to the market, took in more premium, which helped reduce the overall loss on this position. So really good example of kind of managing trades that don't even go against you, especially with calendars. Okay, so the big one that we're going to go over now is LinkedIn. So LinkedIn is really important because it really shows what you can do with trades that go completely against you. And let's not throw anything under the rug here. LinkedIn moved 100% against our original position. So we originally had a short credit spread above the market before LinkedIn earnings. And again, we were playing this directional, and that's okay, you can do that. Hindsight's 2020. We should have had a strangle, but it is what it is, and we were making a directional play. Could have worked out in the other direction. We would have made a ton of money. But in this case, LinkedIn went 100% against our position. Let me just go to the chart here of LinkedIn to show you guys how big of a move LinkedIn made, right? So it made a move well past our strikes and then continued to move higher basically the entire month of August, right? I mean, the whole month of August, the stock has moved 100% against our position. Now, after LinkedIn jumped higher, what we did is did a very wide strangle at 215, which is up here, and at 190, which is down here. So we did a very wide strangle, again, trying to recenter the strategy over the market. Now, a lot of you who don't understand that concept, you'll have to go back through some of the video tutorials. We talk about this a lot, and again, talking about it here. But this whole idea that we're not touching originally our credit call spread. We're going to leave that on originally after the stock made that jump here. And didn't touch that position because it's going to be a full loser anyway. So we want to keep that downside exposure in case LinkedIn does make a complete U-turn. We've seen it a number of times in Home Depot and Lowe's and VXX. Again, right before expiration, 2 days before expiration, the stock just makes a total U-turn. So we are keeping that short call spread on for that purpose. Now, we did this strangle and took in a big credit, and that credit helped increase our break-even point and helped reduce our overall loss should LinkedIn close inside that room of the strangle. Now, as LinkedIn continued to move higher, and I'm just talking about the logistics of what we were doing for this adjustment. As LinkedIn continued to move higher, what we did is we continued to roll up our put side of the strangle. So we did not touch the call side. The call side we kept at 215 for sure. That was absolutely a necessity. We definitely want to keep that. We want to bank profits on the puts that are now decaying in value. So we banked profits on the 190, rolled that up, I believe, to the 205 actually. And then again, as LinkedIn continues to move higher, we just keep rolling up that put side. So this is a really good case study on how to manage a trade that goes completely against you right after earnings. And we were able to reduce the loss by almost $200 on this trade just by managing it and keeping track of these strangles. But the whole adjustment philosophy for strangles in particular is to adjust the side that the market is moving away from. So in this case, again, the market is moving away from our put side. So we just kept rolling up that put side, rolling up that put side. I think we did it a total of 3 times. Every time that we rolled that put side up, we took in a credit and we banked a profit on the put that we closed out. So we closed out a put that had decayed in value, bank that profit, take in an extra credit. Bank that profit, take in an extra credit. Now, at the end of the day, what we ended up with is a small inverted trade at 215 on the call side and 220 on the put side. And what ideally we want to have had to have happened is LinkedIn to trade between that range, which it did. So that gave us the biggest opportunity to kind of close this thing out at a profit. So at the end of the day, what we actually closed out was our 215 call. You can see here on the alert that 215 is tied into this call right here, and then our 220 put. So it was inverted, meaning our put was above our call, but we still took in a massive credit, so that moved out our break-even points. We bought that back for a 550 debit. Now, after all adjustments, buying back the short call credit spread, we bought that back for $1 over max loss. After all the adjustments and all the bank profits, we actually ended up reducing our loss by almost $200. And again, not that this trade was a great trade because we didn't make money on this trade. And again, I'm not shy enough to say, or not bullheaded enough to say that we made money on this trade. We didn't make money on this trade. It was absolutely a losing trade. But the concept that you need to get away from this, and hopefully you take away from this video tutorial on LinkedIn in particular, is that when trades go against you, you can do nothing and take a $700+ loss, or you can manage these trades and learn how to do things like strangles and straddles and adjustments to iron condors, which we actually just made today. We made an adjustment to one of our trades and added the other side of the trade and made an iron condor. But you can learn these strategies to reduce the loss, right? It's easy for everyone to make profitable trades. At the end of the day, you pick the right direction. Things like SPY, they're no-brainers. You take profits on these trades, you make money, and you move on. But things like LinkedIn that move completely against you, kind of those, 1 in 10 or 1 in 15 trades that kind of move completely against you. It's the traders, in my opinion, that are able to reduce that loss, even by a little bit, that end up making a lot more money in the long run because they are able to manage those trades that go against them. So, again, not to say that this was a particularly great trade because we still lost money on it, but in my opinion, I think that this is the essence of trading, is taking losing trades that are 100% against you and cutting the loss from a $700 loss to a $500 loss. If I can do that every time I have $700 losses, that to me is winning because I'll make profitable trades all along the way. So as always, I hope you guys enjoy this video. I know it was a little bit longer, but that's okay. We had a lot of stuff to go over. Again, very, very active markets today. We've already made some trades, so trade alerts are already going out to you guys. If you have any comments or questions, please let me know below in the comment box, and happy trading.